Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Wednesday, January 29th, 2025. It is 2:17 p.m. Eastern Time, so I'm starting the video now, and we're smack between the Fed announcement, which, as expected, was a non-event, and Powell's press conference, which, as I said yesterday, we probably wouldn't see much movement or surprise from the announcement, but the market will hang on every word that Powell says, as they often do. Just a quick reminder, I've said this every Fed meeting now, especially the big ones going back for as many years as I can remember. The initial reaction is quite often not the lasting reaction. It can be. What I mean by that is you get the knee-jerk reaction. Stock market goes either up or down at the 2 p.m. meeting. Then Powell's press conference comes. The initial reaction's almost always faded, and then sometimes that's faded in reverse. In other words, you're going to get volatility. Don't read anything into the initial 2 p.m. reaction. You can start reading a little more if he says something that really makes sense and moves the market during the press conference. I usually don't even do these videos until the day is over and see the dust is somewhat settled. I'm just going to get one out now to give you the levels to watch, because I took I made a post video yesterday, told you I'd take most of yesterday off, which I did. I took the rest of the day off, and I've been watching things sitting here at my desk all day. There's just not well, actually, there's some levels. Yes, there are things I want to point out, and that's what I do. And I do my best to get these levels out in advance, not hindsight. Nobody benefits from hindsight analysis unless once in a blue moon I'll use it for something I missed. An educational example, but what we try to do here is get you the levels in advance and potential developments to watch for. Therefore, you can formulate a trading plan and decide how to act on those developments. What I can tell you definitively is Nvidia is once again at the 200s. Like I said, it's almost a sure thing when you have, and I want to talk on this a little bit. I'm going to get to the FANGs towards the end of the video, but what I noticed, and I recall this last time in the 2022 bear market, Nasdaq peaked in November, the S&P peaked right in the beginning of 2020, November 21, the Nasdaq, and then the S&P peaked right on the first day of January in 2022, and then we had that big drop. And what you get are in the Mag 7, Mag 8, whatever you want to call them, there's always a few stocks that first pull back to the 200 days and then break those. And then the rest, the remainder that are stronger, then come down and then ultimately broke and that's what I think will happen here. So let me get to that towards the end. Let me go over the quick levels. What I can tell you definitively is we're back once again testing those key 200-day moving averages. On NVIDIA, that's the blue and red lines. The blue is a simple, red is exponential. I use them both because some traders use one, some traders use the other. Therefore, I'm going to use them both. You want to see both of those taken out, and they come in close together. Back here, they were quite a ways apart. We hit it in pre-market. We hit the 200 exponential right there. We might even have gone down through there, and that's last time they bought it. So that's there. Pointed out Apple hitting it a week or two ago, and as they do, humans and machines buy the pullbacks to the 200s, especially the first pullback. And especially with a stock like Apple, with the biggest stock buybacks of any company in history, I believe, a 15% drop. They're going to start firing off those buy programs there. Now, the million-dollar question is, where do we go from here? We've gotten the bounce, pretty healthy bounce off the 200s. Again, the levels to watch are these 200s, solid breaks, even better on a weekly close below the 200-day moving averages. And most importantly, not just one, but collectively the majority of the stocks go. Until then, again, do what you want. I've found recently I'm still kind of in that active trading mode. I've been talking about that. That's certainly the case to be as a swinger trend trader, short the indexes. But most of the money has been in this volatility, pullbacks to support, short-term divergences on the intraday charts, things like that. And and also stock selection. You could have been short the markets the last couple of days and long Apple and made money, even though Apple's the top component in there. So, okay, so Apple already hit the 200s. We're going to let's start with the indexes. I'll get to the FANGs, and then time permitting, I just want to talk on a couple other ideas. I want to mention, do an update on crude oil. I threw that out for you, I think about not even a week ago. The grains are starting to get some traction again. I'll try to get to those. That's corn, wheat, soybeans, and time permitting treasuries. Okay, let's start out with I'm going to start out with the futures charts. So that's the clearest thing right now to me. This is just the world of the active trader here. I'm going to borrow this commentary here and put it right there. You can see I've had it drawn in here. So this is a 15-minute chart. That was that recent uptrend line that was broken, powerful sell signal there, plenty of time to get in. Then once that price support level was broken, that was the Sunday night gap down in the futures. Remember, futures close, stock index futures close on Friday evening. They resume trading Sunday night. So this happened Sunday night. We went all the way down there, started reversing. And most recently, we had this divergent high here on the 15-minute chart. That started, we went down today. We took out this price support there, 21,529. And again, these are levels. That's why I'm doing this, not just showing you what happened, but the levels to watch. And we are at pretty good support now, which is 21,416. You can see these reaction highs here. We had a breakout and a back test right there, went up, and now we broke this trend line today. This was pre-Fed, so take everything pre and post-Fed with a pretty good grain of salt. All I can tell you, as I said yesterday, you're going to see whipsaws volatility. I can tell you definitively that we are at support right now, and it's pretty decent support on my 15-minute chart. The next decent support I have, if this one clearly goes, and the level I'm about to show you on the S&P 500, 24,143.50 is my next decent support level. Obviously, the way it works is pull back to support. If the charts indicate other things are coming to support too, maybe you have some divergences, oversold conditions, would indicate that you can go long there with a stop somewhat below for a bounce trade, or just, depending who you are. If you think the market's going to new highs, buy there. You can buy here where it's support now with, again, a stop below. Or if you think we're going to go down, and we might, then wait for a solid break of support, and then that's your next target there. So it works like that. And then on the S&P 500, that is ES, somewhere in these gazillion charts. There it is. This is also a 15-minute chart. That was a divergent high right there. There was your breakdown. Gave you, for futures traders, got you in early on. That was on the close Friday. Then we gapped down Sunday. We had that bloodbath Sunday night into Monday morning. We hit, again, NVIDIA hit the 200-day, which is, Apple had already hit and was rallying, continued to rally. It had already started to rally late last week off there, continued to rally, and then NVIDIA hit, and that was most of this. NVIDIA had a big bounce yesterday off the last 2 days. And down today, and that's why this is down. Again, NVIDIA is a crowd favorite. It is the poster child of the AI bubble. This stock market is 110% about AI, or, well, close to it. We know that. You can see nice resistance. There's a gap. Traders love these gaps. That's where SPY stopped today. With negative divergence right there, and a bearish rising wedge, which broke down today. Here, I'll zoom in so you can see it. Let's see, get a little tighter. That's it. So these are your levels to watch. That's resistance. Obviously, that's your next resistance, top of the gap. And then the final resistance level I have here is about 61.36. And if we break that, we're probably going to see new highs. Otherwise, on the way down, this is support. So I just showed you a second ago NQ at support. Here's the S at support. Powell's about to start the press conference. If you're a gambler and you like going to Vegas and, playing cards and betting on sports, you can certainly, try to game it around. But just remember, the market can move in either direction, very swift and fast. So if you're a nimble active trader and you're used to this kind of stuff, I don't have to tell you how to trade an FOMC day. You've already done that. You know it. I'm pointing out levels so you can trade if you want to do this during or wait till after. These are your levels, 60, 44, about 60, 44. And then the next support I have down here is 590, 59.90, 476. We'll call that 55.95, 59.95. I'm sorry. And those are your levels there. So that's it. So the TA 101 or Trading 101 says when a security pulls back to support, you either go long with a stop below, or you wait until the support breaks, and that would be an objective sell signal. Again, any buy or sell signals today, especially until the Fed's out of the way, take with a massive grain of salt because they have a much higher rate of failure than they normally would based on everything. Oh, and then not to mention tonight, of course, yes, 3 of the big top tech stocks reporting tonight. So again, there's going to be volatility. It can go either way. If you ask me again where the market will be in 2, 3, 4, 5 months from now, down today, tomorrow, next week, it's somewhat of a crapshoot. But remember, we are coming off this. It was a pretty powerful sell signal there. This was the first counter trend rally with a secondary sell signal. Now, with that being said, we've already met the measured target. Here's the wedge. The measured target's pretty much been hit. So my guess is probably bounced during the meeting today. But again, if we take that out and we take out the comparable levels on NQ, probably heading down to the next level. And, nothing would surprise. This wouldn't surprise me at all. The VIX is cheap right now. I'll try to get to that in a second. Great way to hedge up if you are bullish and going long. And if you want to stay short, just put your stops above the levels. Again, stops are going to be dependent on your unique entry point and your unique price target. Somebody just looking for a quick drop down to here or here or here is going to have a lot tighter stop than somebody swinging this thing down to my 50+% drop downside targets on the NASDAQ 100, those long-term targets I've been sharing with you for a while now. All right, so those are the levels. Oh, let's not forget the smallies. RTY, small cap futures. This would be IWM would be the ETF equivalent. Beautiful downtrend line right there. Remember, I'm on a 6-month chart, so 2-hour candles. This is much longer term than the other 2 charts I just showed you. Those were 15-minute charts. Each candle's 2 hours. There's the high right there, which was a big divergent high. Then a beautiful textbook impulsive sell signal with impulsive selling. That's what you want to see. Nice support right here. We had a brief, what I call momentum fueled overshoot with, you got it, my beloved positive divergence. That was a technical catalyst for that bounce. Ended with a rally back into really, really nice resistance recently. As I pointed out the other day, told you that would be an objective short there at both downtrend line and price resistance. That price level is about 23.36. So obviously any pop above there is going to be nothing but bullish unless it fails. Why? Because you'll have taken out, to get there, number one, you're going to have to take out the downtrend line. And then, of course, that's really good price resistance. So as of now, that's not what happened. What happened is we had a rally in there with a bearish rising wedge, negative divergence, and a rejection there. And if you zoom in tight, you can see right now we are just like ES and NQ at support. So you have all the big indexes I follow. Sure, the mid caps are very important. I just like to focus on the S&P, NASDAQ, and the smallies for the most part. And all 3 are at support right now. So that indicates you may get a bounce here. A break above there would trigger a buy signal on the small caps to this next level up here. And again, as I said, a breakout above that would also be bullish. So let's see what happens there. That's the futures. To go over all the ETFs, it just would take forever. I'll just show you real quick. If you're, for example, same downtrend line on when you go to the ETF. This is IWM. There's your downtrend line. And that's the resistance was a little clearer on RTY, the futures I just showed you. But that's the recent divergent low right there. And that was the most recent divergent high. This is swing trading. Swing it down, swing it up, swing it down, or break out, and then you're back long again. Okay, let's rifle through the big tech stocks. This is QQQ. This is just a long-term trend line. It comes off the January 2023 lows, which we're just above now. So obviously, these are the big levels. If that breaks, and then this level here, about 449.47, that would be bearish. And then that's probably going to take you down for a test of the 200-day moving averages. As of now, this is another big index at support. It's the same one. I showed you NQ at support and ES a second ago and RTY, but this is on the more important daily chart. So again, kind of favoring a little bounce here unless those levels are taken out. But let's look at all the big tech stocks. Apple, I know busy board here, but this was the primary uptrend line off the April lows in Apple breakdown here. There's the hit of the 200-day moving averages I highlighted last week or a week before in the subsequent bounce, but we're still below that trend line and well below that divergent high right there. So I'm still viewing this as a counter trend bounce. Any back test of the uptrend line would offer an objective short entry, although I like to see a rejection once you're back testing. All the better if you can get that. And even better if you don't back test. Obviously, it would help the longer term bearish case. So very near term, again, if Powell wasn't there today, with a higher degree of confidence, I would say. So, just if you're going to game a bounce, I'm going to try it. I tried it here. I covered there and went long before this video, right before it started. But it's a short, small position. I'm not going big on a Fed day. But I do think it's worth the risk with a stop just below. Apple, there's Microsoft right there. Microsoft, the primary trend line, there's a big, much longer term, that purple trend line. We're well above it. Microsoft has been flirting with the 200-day moving averages. I'm going to get to that in a second, show you. This looks just like what Amazon did back in late 2021. Amazon was one of the first ones to pull back and test and then struggle with its 200-day moving averages. Now Microsoft looks very similar. Again, I'll try to get to that in 1 second. NVIDIA, I already covered on the 200s now. Amazon, comfortably above the 200s. I'm going to turn off the lines just so you can see the 200s are right here where my crosshairs are. And when I turn on the lines, you can see these are the levels I'm watching. I have an uptrend line off this August 5th low right there, well-defined. Break of that. And then the BOD, or benefit of the doubt, support just below it around 217-ish right there, this recent trading range. Those two levels would be sell signals, especially a break of that 217-ish right there. And that should take you down to the 200-day moving averages. Alphabet, GOGL, there's your primary uptrend line in yellow off the 2023 lows also. A lot of stocks have those January 2023 low uptrend lines. And divergent high, negative divergence. Again, I have a high degree of confidence we will be going down in the near future, and today or this week, the earnings tonight and tomorrow certainly have the highest potential to be the catalyst for that. There's a whole lot going on in DC right now, catalysts that are moving the markets, or potentially, and of course the AI disruption with the new DeepSeek AI. There's a lot out there right now, guys, but these are the levels to watch and how to trade it. And so, look for, if we start moving lower, you're probably going to see the rest of these MAG 7, 8, whatever you call it, stocks come down to their 200-day moving averages. And if they take those out, then that's going to open the door to much more selling. And you can see how beautiful these 200-day moving averages come right in line with this uptrend line. It's almost like a magnet of a target. If I was not a big put person, but if I was going to buy puts and I want to know kind of where, plug into the formula, there's that time element. That's one reason I don't do puts and calls often. I once in a while, very judiciously, but and if you're going to do them, do paired strategies. You can hedge your, if you know what you're doing on options, that's a whole nother thing to get into. But what I'm getting at here is if you're going to do it, one reason I prefer straight shares is, when I have a high degree of confidence on my price target where something's going, that's one thing. So it's hard enough for someone to call security to an exact price level, and that's what I tend to do with precision. Exactly where something's going to go, not just a rough price target range. But then it brings in a whole another degree of difficulty to not only say where a stock is going to go to make a big call, double digit or plus call, but when it's going to get there. That's where options, you got to be right on both where it's going price wise and when it's going to get there, or you'll just watch the premium on those options melt down. But either way, I have a high degree of confidence that's where we're going, and probably sooner than later. Again, this week could be certainly the catalyst. So there's Alphabet, Meta. I have a bunch of lines on Meta. I guess this is a busy board. I'm just going to turn off all the lines so it's not so busy, and you can make it out in the video what I'm looking at. This trend line right here off this spike low in October of 2023 is the uptrend line I think right now is most important. There's your 200 days. So Meta is comfortably above the 200 days. Like everything else, it has big negative divergence. Those stocks that don't currently have negative divergence already just put in a divergent high and have already been correcting, like Apple and some others that I highlighted. So Meta, again, to hit the 200-day moving averages, the stock's going to have to drop about almost 20%. So it kind of gives you an idea where we're likely headed. Tesla, again, Tesla's going a whole lot lower. I maintain these longer term targets. Big divergent high, already moving lower. And 200 days are way down here on Tesla. All right, let's go visit. So I just gave you a kind of a recap on the 200-day moving averages. Let me go to a weekly chart. Let's do this. I'm going to keep the lines off. On my weekly chart, I have the 40-period simple and exponential, which are the same exact things as a 200-day moving averages on a daily chart. 5 days in a week, so 5 times 40 is 200. So these are your 200-day moving averages. And I just want to show you how things were back in 2022 or late 2021. Apple was one of the strongest stocks. This is when the S&P topped. The NASDAQ peaked just before that, right in the beginning of 2022. You can see Apple was comfortably above the 200-day moving averages at the time. So it's almost like a flip around this time around. And then came back in to test it because a couple others I'm going to show you at that point were already falling back, some of the big market leaders. And then so Apple and the rest of the lot eventually followed, as they always do, or not always, but usually do. They bought the first pullback to the 200. We got a tradable bounce, equivalent to what I see that just happened in Apple right here, right? And then ultimately the 200s went. And then they rallied back. They had a brief overshoot, failed. And then that bear market ended with that. And that was a drop of, the whole thing, high to low, was only about 32. Remember, Apple was one of the strongest. A lot of these other big tech stocks fell 40, 50% or more during that late 21 to late 22 bear market. All right, so there's Apple, just showing you what happened back then. Here's Microsoft. My crosshairs are on the beginning of 2022. So Microsoft was also, when the NASDAQ peaked back here, was also one of the strongest. But as others were already there, it brought Microsoft back. They tested the 200 for a couple weeks, lost the 200s, back tested, rejected. So once you're below the 200s, the MO is to short rallies back to them. Short it. And then that's where the bear market ended, and that was a much bigger drop. So that one again was stronger, got taken down there, and then finally broke it. Nvidia back then peaked back here, also right in the beginning of the year, tested the 200s. So you can see, remember, the NASDAQ peaked back in November, right around, I think it was November, late October or November, right around here. And those that were strong, just like right now, the strong ones came down when the other couple, the first few, which I'm about to get to, hit. And then they ultimately broke down. So that's what I'm looking for here. Amazon was one of the weak ones back then. It's one of the strong ones now. This is Amazon now. Here's your 200s, very strong. But back then you can see Amazon was hugging and clinging to those 200 days like what I like to say, a tired sailor that thrown overboard in rough seas, clinging to a life preserver, just exhausted. This stock was just clinging. It wouldn't break them. Why wouldn't it break the 200s? It rode on them, and we kept having bounces. You could buy every pullback, and these are double-digit gains. But it's not going to take out the 200s. This is one of the indexing is so tight now. These companies have such a strong correlation. It would be extremely unusual to see Amazon way below the 200s and the rest of the Mag 7 or 8 above it. So that's what happened. This stock was weak. It was hugging the 200s, heading into those the peak there, and then ultimately gave up the ghost right here. And it was a very simple and effective trading strategy. Just short the rallies back, or if you go long in the counter trend. We gained both counter trend bounces in that bear market long from the lows to the highs, and then this is where we took them all back there in the beginning of 2023. And Amazon and Apple were my two top picks right from the get-go in January, start of the year in 2023, right here off the lows, and especially Amazon, based on, you can go back and read those posts if you weren't here. So that's it. So that's what we're looking for. This one was weak back then. Alphabet right there, lost right in the beginning of 2022, pulled back, gave up the 200s, had a bear market. Once it gave them up, tried to take them back, couldn't do it, rejected, finally took them back here right in the beginning of 2023. All right, so that's where we're at, and this is one of the stronger ones. So I could go over and over. Here it is, Meta. Meta was one of the weak ones back then. See here, Meta peaked here, came down, fell to the 200s. This is back in, I'll tell you exactly when it was, October, early October. And some Meta, like Amazon back then, were the two, these were the two big ones and the two weak ones that were sucking wind. Oh, and Tesla. Tesla had already kind of rolled over back then. And actually, no, take that back. They peaked right here. So it was those two, Alphabet and Meta, that were kind of the first tells, just like Apple and NVIDIA right now. Those are the first two to hit the 200s. The rest will come down soon. I'm gonna let's move forward here. I want to actually trade. Let me wrap the video up. We're starting to bounce off those levels. Where'd it go? We'll see if it sticks. Oops. Oh, hold on. Yeah, sorry about that. I had to reverse. That's what I wanted to do. I was kind of just eyeing things and didn't have my set reversal orders in. So there, what it is that's a breakdown and backtest. So there's that level. Like I said, support right there. Broke down today. Hit this support level. There's the bounce right to a perfect backtest. And so I'm going to wrap this video up and then kind of fly by wire, watch 5-minute charts, 15-minute charts, watch all the big stocks, and then decide. But there's a good chance the shorts I just reversed into, just closed the longs reverse, I'll probably take those home unless something else happens. But let me get to the other things I wanted to cover for you real quick, which is crude oil. Let's do crude. Okay, this is CL crude futures. USO traders, you'll just have to, try to replicate. You're not going to get the same lines because you don't have the round-the-clock trading. Back here, I think it was about a week ago, I highlighted crude as a buy right above $72. I'd step in always. That was the only level I had there, 72.05, but you always want to buy a little before the support in case they step in early. And I've added since this line at just above it, about 72.25. And so far, and we did. It was a nice tradable bounce right up to the downtrend line off the highs. Everything was on the chart here, the divergent low, the downtrend line. We hit that and that price level, my first target, 74.50. Perfect point to reverse, pull back, and we're back there now. And so what I can tell you definitively, crude is at support. Again, with positive divergence, the divergence has gotten even larger, offering an objective long entry here with a stop somewhat below. And or means buy at support here, partial position with a break above that trend line on a second. So let's say you did a third or a half position here at support with a stop below. That would be your add-on there on a breakout above there. And we already hit that target once, which increases the odds we may go up and hit that second and or third target if that holds. If this happens, it's not going to be good for the stock market. Stock market already has come under pressure recently. You can say it's due to DeepSeek, and you can say what you want, but I can tell you, we all know that inflation is everything again, as I predicted it would be when everybody, it's over, the Fed won. No, this is commodities, what I've been harping on. And this is the resurgence of it. Crude's been rallying. Ag commodities are moving up. Let me show you those real quick, and then I'll show you the broad-based commodity ETF. This is ZW wheat, one of the three big grains. This is that same 120-minute chart I've been showing you for a while. In the last week or so, I've just, in the updates, I've just said, hey, the grains still look good, taking a breather after the breakout, and still look good. So we broke out, back tested, another near back test. Back to where we are. We're up almost about 3% today. So nothing big, but again, I'm still looking at this. I have much longer term swing and trend targets on the grains. We just need to now pop this level on wheat futures. That's about 567 should do the trick. That's a magic number. It should take us up here to my next target zone, then here, and then we'll turn our focus to the longer term charts. You can, for your ETN traders, the one I gave you for that is wheat, WEAT. Same thing, nothing's changed in the last few weeks. We had the bullish falling wedge breakout and successful backtest. That's the same thing I just showed you on the futures right there. This ETN tracks the futures, so you can, if you don't have a futures account. And so there you need to pop Obviously, the recent highs, would do the trick. But I've had this level here for quite some time, about 503. So really about $5. Pop $5, that should run up there, and then any of those longer term targets. Corn, wheat, and soybeans start, continue to move. Corn hasn't looked back since the breakout right there. Really, it's been just steadily moving up. It's at that 2022 resistance now. Remember, these are long-term trades I've been highlighting for into early last year, many of which hit the first, second, or third targets. And so these are still the longer-term targets. This was just a marginal new low, not low enough to exceed any reasonable stop for those targeting those longer term targets. And so, and we just put in the only difference, the divergence was even bigger. And either way, still looks good, but we need to pop these previous highs, obviously, to open the door to these deeper targets, soybeans. And again, I've told you I'd like to take a shotgun approach. That means spread it out in all of them. I do have an overweighting in wheat still. I believe that'll play a game of catch up. It tends to follow corn and soybeans, especially corn, closely. And usually when one gets too far ahead of the other, the one that's been lagging plays a game of catch up. So there's your, those are the targets I gave you more recently, some revised targets. There was a breakout in soybeans. So still looking good. And what else? What else do I have for you? Let's wrap it here. Treasuries, I told you the other day, I'm lukewarm. I'm not as hot as I was before. This is TLT. We need to pop this recent high to hit. I think I gave you targets on the 60. Yeah, I did. These are the targets. So still looking at move up here to at 89.65. Although really the futures are what I'm eyeing the closest and what I trade personally. Although I do still have TLT in some accounts. There are some accounts that I have many family accounts, personal accounts. Some I don't even use futures in. And so I have TLT. It's nothing wrong with TLT. It tracks very well. There's ZB. And again, we keep hitting this level here, about 14,260. And you had, as I pointed out the other day, a potential inverse head and shoulders pattern with a head, left shoulder, right shoulder. So if we could pop that, that should be bullish. That's a 6-month chart but this is pretty good resistance, and we still have that negative divergence. Remember, we just put it in divergent high, so I'm not married to this trade, and I'm not as heavy in as I was recently, but I still like it, especially as a hedge to index shorts for the reasons I said, because if treasury bonds go down, you're going to lose money on your treasury bonds, but that's going to be bearish for stocks because that means rates are going higher. And as I've mentioned, it's been a pure play trade as well. And let me show you ZN and I'll wrap up. I often say I'll trade TLT or ZB for the juice, the 30-year bond, because it tends to move more up and down. But this is what the markets watch most closely. This is ZN, the 10-year Treasury bond. You can see my chart. That was a bullish falling wedge that we broke out of recently. Big, powerful buy signal, big divergent low. But again, we put in divergent high here. And I remain longer term bearish. And I haven't wavered on that on Treasury bonds. I believe the case I've made for couple of years now that we've entered a new secular bull market in yields, which is a bear market in bonds. But I'm going to trade this thing. I'm not positioned. There's going to be plenty of room, and bonds have been just a very easy, very swing tradable instrument, long short in the last couple of years. With a high success rate. In other words, they trade just well to the technicals. Now, the technicals are, you have an uptrend line here, obviously not good if we break it. There was a downtrend line right there that we broke and we're back testing now. And then this is really support right here. This is the level right here where if it breaks, we're probably going to go lower, quite a bit lower. And that's 108, about 108.057. So yeah, 108.057. However, remember, this was a pretty big, very big divergent low, powerful stuff. And these are still potential upside targets. If the stock market goes down, you can get a flight to safety bid. And if these go up, you could see that if these go up, that means yields are falling. And you could actually see stocks rally as well. So, again, at this very moment, we'll see. Right now, this still looks okay. This is where it starts to not look so okay, down below those levels. Okay, let me wrap it up here. I wouldn't mind listening to what Powell is saying right now. If I probably missed most of it, I'll get the summary later. I usually just watch during Powell's press conference just to see what he says. For those of you that have the Schwab's Thinkorswim, it used to be TD Ameritrade, now it's Schwab. There you can watch CNBC in a pop-up. It's beautiful because there's no commercials. You just go in the left-hand side of the grid, the Thinkorswim thing, pop that open, and then go to. It's in there. If you can't find it, let me know. But they have live CNBC that streams. So I've got multi-monitor set up, put it in one window, and then Interactive Brokers, which I have too. They give you a free stream on Bloomberg, so you can watch. Of course, you could have a TV in your room. which I do. I just like watching a little pop-up, small screen. I don't need to really see, what's going on there. I just want to hear what they're saying, what Powell's saying. And so that's what I'm going to do right now. So let me get the video out to you. If anything major happens today, I'll do another end-of-day video. Otherwise, I think this will probably be it for today, unless something stands out. We'll let the dust settle, pick it up tomorrow, especially after the big tech earnings tonight. And again, just expect volatility this week, and volatility cuts in either direction. This has been Randy Finney with Right Side of the Chart.